It was a huge disaster for the stock market today as the Federal Reserve came out with its FOMC statement, followed by the presser by Jay Powell 30 minutes later. Initially, the market reaction was pretty good. It rallied about 1% higher, only to see the S&P 500 drop 135 points off of the highs of the day. Now, initially, people were thinking when they read the statement that, oh, this is a pivot, man. They inserted some new language. We like it. CNBC was being the clowns that they typically are, and they went all full tilt on the fact that the Fed was pivoting, that this was the dovish tilt that we were looking for to come in this particular statement. And then when he started talking, he's like, no. He's like, I'm willing to over-tighten and to make sure that inflation doesn't become entrenched in society. And so what do? You get the massive sell-off. And you get the clowns at CNBC looking like clowns again. I mean, I have no idea why anybody even watches this. I only turn it on just to actually watch the presser. But beyond that, it blows my mind why anybody would actually pay a lick of attention to what CNBC has to say. Now, on the day, the S&P 500 was down 2.5%. You had the Russell down 3.4%, and you had the NASDAQ down 3.4%. But what was really noticeable is how much the FANG stocks are absolutely getting brutalized throughout earnings. And now after earnings, we thought, okay, maybe the FANG stocks will start to rally again now that they got earnings behind them. No, Amazon, it's down 10% over just the last 2 trading sessions. And that's on top of the horrible earnings that they put out. Google's the same. I mean, it's just Apple, Google, Amazon, Microsoft. They're just getting destroyed. And because their market caps are so big, it's just wreaking havoc on the rest of the market. So what I want to do with this video here today is I want to go over the charts. What are the charts telling us now that we're 135 points off of the highs of the day, that it starts to look like now we might be starting the next leg lower, that this dead cat bounce that we've been talking about for a month or so, it might just be over. So let's get to the charts. But first, make sure you like and subscribe to this video. It helps me out quite a bit. Plus, click the join button down below if you want to get my members exclusive videos each and every day. I send out an additional 10 plus videos plus additional posts on watch lists and different things that I'm watching throughout the day. So check that out down below. Click the join button. Now to start off, we're going to look at the SPY on the weekly chart here. And you're going to see on this weekly chart, we got that couple week bounce that I was expecting us to get that I've been talking about in previous videos. We got that right here. It's lasted for about 4 weeks. To be exact, 3 out of the last 4 weeks, it rallied. This week, it's looking a little bit different. This goes back to what we've seen with historical precedent, where when it touches this 200-week moving average, it tends to bounce, right? You got it here again in 2016 as well as 2018. And then if we go back to 2008, you could see it as well, where we bounce for a couple months right here, and then we bounce for another couple of weeks right here. So just because we bounce off of it doesn't mean that it's going to ultimately hold it. Just like with 2008 and 2000, where it bounced, it ultimately fell apart. If you look at the Qs, it's the same thing. Let's look at the Qs here. You can see we bounced for a couple of months right here on the 2008 test of the 200-week moving average. And then you go back to 2000, and we bounced in a very similar fashion to the way we've just recently bounced right here. So there's precedent for what we've seen over the last few weeks before it ultimately breaks below the 200-week moving average. That's why I'm getting a little bit nervous about after what we saw today from the Fed, that this market isn't just going to go ahead and completely fall apart like what we've seen so far. In fact, it's already trading below it on the 200-week moving average, but on the SPY, it hasn't yet to actually fall below it. Now, let's take a look at SPY's monthly chart. And this is where it gets pretty interesting as well. You have the 50-week moving average. We got that 1 month pop off of that 50-week moving average. We also saw bounces off of the 2008 and 2020 sell-offs on that moving average. Now, go all the way back though. This is 2008. We bounced for a couple months right here, but then we quickly fell apart. You go back to 2000. You got that 1 month bounce, but then we quickly fell apart yet again. So right now I'm becoming a little bit skeptical about how well this market can hold up now going forward, especially after Jerome Powell has reiterated his determination to continue raising rates, even going beyond what most people thought was even likely for the Federal Reserve in order to destroy inflation. Now let's take a look here at SPY on the daily. Now, one of the things that's interesting is that you had a consolidation, then you had a respectable breakout to the upside that tested the declining trend line. Same thing happened in June and July. You had the consolidation followed by a massive rally. But now, what we've seen over the past couple of weeks is looking very similar with this somewhat of a breakout, very small breakout followed by a quick period of consolidation and then the pullback. Very similar to what we saw right here in May, where it looked like we were going to break out and then took the next leg lower. So now what we're really looking at is forming a new low similar to what we did here in June. Now check this out. You have some resistance that has failed over the last 3 days. We've tested this resistance level 3 straight days. This is this head and shoulders pattern here that was formed, broke down, rallied back, hits this yellow line of resistance. That's the neckline. Tested the last 3 days and was unable to break through it. Tried again today, could not break through it. And now what do you see? You see a massive 2-day sell-off that suggests that, hey, we're taking this next leg lower on this market. There was also the possibility that we could have bounced off of this breakout level from this base right here that I highlighted in the previous slide. Instead, after consolidating, we pulled back to this level today and then we sliced right through it. So that one's off the table and we can just go ahead and delete it because it means nothing at this point. So I think whether it's the SPY, whether it's the Qs, the June lows are back on tap. You look at it on IWM. This is the only index that did not break the June lows. So this one has shown a lot of relative strength when you compare it to the SPY and the Qs. This here too, I would expect that with that kind of a sell-off today, it led the way to the downside. There was no relative strength in it today. There's a good chance that we're going to see a retest of those June lows. And if that one breaks, then I think there's going to be a watershed moment for the Russell 2000. One of the things that we are seeing in this market right now is a lot of weakness in the FANG stocks, weakness that we haven't seen in quite some time. You're seeing things like Amazon and Apple, they're getting crushed. You're getting Meta that's continuing to drop. It's like 70% off of its highs. Google continues to get the crap beat out of it. And Netflix, really promising just a couple of weeks ago, starting to fall apart yet again. And then you got stocks like Amazon that has a PE of 89 and Tesla has a PE of 66. Do we really think that they're going to weather this storm very well with it having those kinds of earnings multiples? No, I don't think so. I think that's going to come back down. And because these stocks have such huge market caps, it's going to drag the whole market down back with it. So I think today was a big day. I was open until the FOMC statement came out, followed by the presser. Up until that point, I was pretty open about the fact that this market might be able to sustain the rally, but you did not get a Fed pivot. Despite some journalists that everybody got excited about saying that there would be a pivot, there wasn't a pivot. So now we have to hunker down again and not be surprised if we see the September lows get taken out again. One of the biggest things that we can do as traders is not to mistake activity for opportunity. Every time there's a price move, especially on the intraday charts, it's very easy as traders for us to get sucked up into that kind of price action, but we can't allow that to happen as traders. We have to look for the opportunities, not for the action. If we get sucked up in the action, we're going to make a lot of bad trades and take on a lot of avoidable losses, and we don't need that if we're going to survive this market. Patience pays. The less you do, the better off you're going to be for your portfolio, so take it slow. Let the opportunities come to you. Don't try to force action that's not there. If you enjoyed this video, I'd encourage you to like and subscribe. Let me know down in the comments below, what is your expectations for the stock market over the next 3 months to close out the year? I'd love to hear from you guys. And make sure to click the join button down below so you can get more of my videos for the members only of this channel. And yes, like and subscribe. Thank you guys, and God bless.